If I had to start investing from scratch in 2026 after losing everything I had built, I wouldn't try to get rich fast. I would do the opposite. Most people start investing for the wrong reasons, chasing trends, hot tips, and easy promises, and that's exactly why they quit early. In this video, I'll show you the path I would follow step by step to build wealth the right way, even as a beginner, even with little money, and even if you're starting late. No magic formulas, just simple decisions repeated consistently. After studying investing, observing common mistakes, and seeing what actually works over the long term, I came to a clear conclusion. Investing well isn't about intelligence, it's about process. And it all starts before the first investment. Before stocks, ETFs, or any strategy, there's a foundation that almost no one builds with real intention. If investing were just about picking good assets, most people would be rich. But the real problem is almost never a lack of money, it's a lack of clarity. Most people work, get paid, pay bills, and repeat this cycle without ever stopping to understand what's really happening with their money. That might be your situation too. You try to save, but there's always an unexpected expense. You use your credit card as an extension of your paycheck. You make small daily purchases that seem harmless, but by the end of the month, they consume a huge portion of your income. And when something is left over, investing feels too risky. What few people realize is that investing without fixing this first creates anxiety. Every market fluctuation becomes a reason to panic because that money was never supposed to be invested. It was still needed for real life. That's why so many people enter the market excited and leave frustrated. It wasn't the investment that failed, it was the foundation that never existed. High-interest debt, disorganized spending, and automatic financial decisions turn any strategy into a house of cards. Imagine trying to fill a bucket with holes. No matter how much you pour in, the money keeps leaking out. Before investing more, you have to seal those leaks. Understanding this changes everything. When you gain control, investing stops being scary. It becomes just the next logical step. And that's exactly why, if I were starting in 2026, my first practical decision would have nothing to do with the market. It would be about organizing my own financial reality. And from that point on, we begin the first practical step. Because without organization, any investment is just hope disguised as strategy, not a real financially sustainable plan. If the real problem isn't a lack of money, but a lack of clarity, then the first logical step is simple: organizing your personal finances. And that doesn't mean complex spreadsheets or extreme cutbacks. It means creating awareness and control. If I were starting in 2026, I would begin by looking at three very clear areas. The first would be debt. Not all debt, but especially bad debt, high-interest debt that works against you every single month. While it exists, any investment has to win an unfair race. Paying off or reducing this type of debt is, in practice, an investment with a guaranteed return. The second area would be basic spending control. Not to live a restricted life, but to understand patterns. Where does your money actually go? Which expenses are fixed, which are impulsive, and which don't bring real value? Many people discover they could already be investing simply by adjusting small decisions that usually go unnoticed. The third area is predictability. When you know how much you earn and how much you spend, investing stops being a leap in the dark. It becomes a calculated decision. Even small amounts start to make sense because there is now real room for them. This organization creates something more important than money: peace of mind. You stop living in reaction to problems and start acting with intention. Investing stops feeling distant and becomes just another well-placed habit within your financial routine. And when this foundation is in place, the next question naturally arises: how do you protect this progress from unexpected events? Because before thinking about growth, you need to make sure an emergency won't destroy everything. That's exactly where the next fundamental step comes in. After organizing your financial life, there's a classic mistake many beginners make: jumping straight into investing without building protection. If I were starting in 2026, an emergency fund would be an absolute priority, not an option. Unexpected events happen all the time: health issues, loss of income, surprise repairs. Without a reserve, a beginner investor is forced to sell assets at the worst possible moment, exactly when the market is down, and that turns a correct investment into an avoidable loss. The emergency fund exists to separate real life from the financial markets. It ensures you don't have to touch your investments when something goes out of control. The general rule is simple: save between 3 to 6 months of living expenses, not your salary, but your essential expenses. That detail makes all the difference. In 2026, this money should not be chasing high returns. It should be focused on safety and liquidity. The goal isn't to grow, it's to be available. This is the fund that lets you sleep peacefully even when everything around you feels unstable. Building this reserve doesn't have to be fast. What matters most is consistency. Set aside a fixed amount every month. Treat this fund as a priority rather than leftovers. Over time, it becomes an invisible layer of protection that supports every future decision. And something interesting happens when the emergency fund is complete. Fear decreases. Investing stops feeling dangerous because now you know you can handle unexpected events without destroying your plan. With that security in place, the next step stops being emotional and becomes rational. Understanding, in a simple way, how investments actually work before putting real money at risk. With your financial life organized and an emergency fund in place, the next step becomes intellectual rather than emotional. Before investing real money, you need to understand the basics, and the good news is that this doesn't take years. If I were starting in 2026, I would focus on learning only what's essential, no complicated terms or advanced strategies at the beginning. The goal here is to understand how money grows, not to try to beat the market. The foundation revolves around 3 pillars: stocks, ETFs, and fixed income. Stocks represent ownership in companies. When you buy a stock, you're buying a small piece of a real business. ETFs are collections of assets bundled into a single investment, providing automatic diversification. Fixed income, on the other hand, works like a loan, with clear rules for returns and lower volatility. But just as important as knowing what each asset is understanding what they are not. Investing is not gambling. It's not about growing wealth quickly or looking for shortcuts. When someone enters the market expecting to get rich in a few months, frustration is almost guaranteed. Learning the basics also means accepting that volatility is part of the process. Markets go up and down, and that doesn't mean something is wrong. The mistake is not knowing what you're doing. This learning phase can be done in just a few days, as long as the focus is clarity rather than complexity. When you understand the game, you stop reacting on impulse. And it's exactly this clarity that allows you to take the next step with confidence, because understanding investments is important, but choosing where and how to invest requires a practical structure. And it all starts with a simple decision: where to open your account and take your first steps safely.
After understanding the basics of how investments work, an inevitable practical question arises: where to invest? And here, many beginners make another common mistake: believing they need the most complete brokerage, full of charts, advanced tools, and dozens of complex options. If I were starting in 2026, I would look for the exact opposite: simplicity. A good brokerage for beginners needs to be safe, reliable, and easy to use. Nothing more than that. The fewer obstacles there are between you and the act of investing, the greater your chances of staying consistent over time. Fees also matter, not because they'll make you rich or poor overnight, but because unnecessary fees quietly eat away at returns. A clear, transparent structure with low costs makes better decisions easier and helps avoid future frustration. Another essential point is trust. You need to feel confident putting your money there. That includes regulatory protection, a solid track record, and a good reputation. Investing already involves enough uncertainty. The platform shouldn't be another source of worry. Starting simple doesn't mean thinking small. It means reducing mistakes early on when they cost more emotionally than financially. An easy-to-use platform allows you to focus on what really matters: investing consistently and with discipline. Once the structure is well chosen, the next step stops being technical and becomes strategic. Now that you know where to invest, the most important question arises: what to invest in first? And for beginners, the smartest answer is rarely picking individual stocks. That's exactly why the next step revolves around a tool designed to simplify the game from day one. After choosing a simple and reliable brokerage, the most important decision becomes where to place your first dollar. And here, many beginners believe that investing well means picking specific stocks, trying to find the next big company, or beating the market. If I were starting in 2026, I wouldn't do that. I would start with ETFs, and the reason is simple. They were designed to reduce mistakes. An ETF brings multiple companies or assets into a single investment. Instead of betting on one specific name, you invest in an entire group, gaining automatic diversification from your very first contribution. For a beginner, this is powerful. You reduce the impact of bad decisions, lower volatility, and eliminate the pressure of getting individual picks right. Instead of relying on one company to succeed, you grow alongside the market as a whole. ETFs also simplify your routine. You don't need to follow earnings reports, daily news, or make constant decisions. This helps keep the focus on what truly matters: consistency. Investing well isn't about frequent moves, it's about maintaining good habits over long periods of time. Another important point is that ETFs fit perfectly into a long-term strategy. They allow you to benefit from economic growth over time without needing to reinvent the wheel. For beginners, this builds confidence and reduces anxiety. Starting with ETFs isn't a lack of ambition, it's strategy. It's understanding that the initial goal isn't to maximize returns, but to minimize mistakes. And when you eliminate the most common mistakes early on, you create space for something even more important: investing regularly. And it's exactly this consistency that separates those who try to invest from those who actually build wealth. Knowing what to buy is important, but knowing when and how to invest consistently is what turns a good asset into real results over time. After choosing good assets, the next challenge isn't technical, it's emotional. Even with ETFs, many beginners get stuck on a dangerous question: is now a good time to invest? If I were starting in 2026, I would eliminate that doubt by using a simple strategy: DCA, or dollar cost averaging. In practice, DCA means investing a fixed amount at regular intervals, regardless of what the market is doing. You invest when the market goes up, when it goes down, and when it moves sideways. It sounds almost too simple, but that simplicity is exactly what protects beginners from the biggest mistakes. When you try to predict the market, you end up buying based on emotion, buying when everything feels safe, and selling when fear shows up. DCA removes that pressure. It turns investing into a habit, not a constant decision, and habits are far easier to maintain than repeated emotional choices. With DCA, you automatically buy more when prices are low and less when prices are high. Over time, this smooths out your average cost and reduces the impact of volatility. You don't need to be right in the short term to win in the long term. More importantly, DCA builds discipline. It shifts the focus from when to invest to how much to invest every month. That completely changes your relationship with the market. Instead of fear, you begin to see downturns as a natural part of the process. This strategy doesn't promise fast gains, it promises something much better: consistency. And consistency is the true engine of financial growth. When investing becomes routine, external noise loses its power. News, crises, and opinions stop controlling your decisions. And it's precisely this emotional stability that allows you to clearly see the dangers that still surround a beginner's path, especially the easy promises that sound too good to be true.
When you start investing consistently, something inevitable happens. The noise gets louder. Promises of quick profits appear, stories of people who got rich in months, and gurus claiming their method is different from everything else. If I were starting in 2026, I would have one clear rule: automatic skepticism toward anything that sounds too easy. Financial fads work by exploiting basic emotions, greed, fear of missing out, and urgency. Miracle cryptocurrencies, day trading for beginners, bets disguised as investments. None of this is presented as risk. Everything is sold as a once-in-a-lifetime opportunity, and that's exactly where the danger lies. Beginners don't yet have the emotional structure to deal with large swings or fast losses. When that happens, the reaction is almost always to abandon the entire plan, not because of a lack of ability, but because the path chosen was unstable from the start. Investing well in the beginning isn't about multiplying money, it's about protecting it. Avoiding big losses is far more important than chasing extraordinary gains. Those who survive long enough in the market usually end up winning. Once you understand this, it becomes easier to say no. No to shortcuts, no to empty promises, no to strategies that depend on luck. That filter is what keeps your plan intact when everyone else's excitement fades. And with that noise removed, there's room for what truly matters in the long run: time. Because the sooner you understand that investing is a long journey, the sooner you start working in favor of your greatest financial ally. After eliminating fads and dangerous shortcuts, what remains is something almost no one values at the beginning, but that makes all the difference at the end: a long-term mindset. If I were starting in 2026, this would be a conscious decision from day one. Most people invest thinking in months. Real investors think in decades. This shift in horizon completely changes how you react to the market. Declines stop being threats and become a natural part of the journey. The focus moves away from the short term and toward the process. This is where compound interest starts to make sense. At first, the results seem small, almost invisible, but over time, growth accelerates, not because you became smarter, but because you gave time enough time. Money begins working for you quietly and consistently. Having this mindset also reduces anxiety. You stop checking the market every day and stop reacting to news and opinions. Instead, you trust the plan. And trusting the plan is what allows you to stay consistent, even when everything feels uncertain. Thinking long-term doesn't mean ignoring the present. It means making decisions today that your future self will be grateful for. Every contribution, no matter how small, carries the weight of time working in your favor. When this mindset is clear, an important realization emerges. Investing well isn't just about choosing assets or strategies. It's also about creating more capacity to invest, because the more you're able to invest over time, the faster this effect multiplies. After adopting a long-term mindset, it becomes clear that there's a limit to what strategy alone can do. If I were starting in 2026, I would understand early on that increasing contributions is just as important as choosing good investments. Many beginners spend energy trying to find the perfect strategy when the real accelerator exists outside the market. Earning more money amplifies every right decision you're already making. A simple plan with larger contributions almost always beats a complex plan with little capital. That means investing in yourself, developing skills, improving your career, creating additional income streams. Every increase in income translates directly into more money invested, and more money invested accelerates the power of compound growth. The market rewards those who can stay invested for a long time with increasing amounts. That's why focusing only on percentage returns is a common mistake. What truly moves the needle is the combination of time, consistency, and growing contributions. Once this logic is clear, the final step stops being technical or financial. It becomes behavioral, because everything built so far only works if you can follow the plan without emotionally sabotaging yourself. After understanding that investing is a long-term game, supported by consistency and growing contributions, everything comes down to one thing: following a simple plan. If I were starting in 2026, I wouldn't try to over-optimize. I would create a system that's easy to execute and hard to abandon. That plan would have 3 basic rules. First, invest a fixed percentage of income every month, no exceptions. Second, rebalance in a simple way just to keep the strategy aligned over time.
Third, don't make decisions based on emotions, especially during crises. When the market falls, and it will, the plan is already decided. That removes doubt, fear, and impulsive reactions. You don't need to be smart all the time. You just need to be disciplined. Investing well doesn't require genius. It requires repeating good decisions over many years. And the simpler the plan, the greater the chances you'll actually stick with it. Financial freedom doesn't start with a lot of money. It starts the moment you decide to stop improvising and start trusting a clear, consistent, and sustainable process.